Okay. All right, and we should be live on two channels at the same time. This is very cool for everybody joining us. Give us a thumbs up. Let us know that you're receiving us all right. We are Kenny Robertson and I. Let's talk money. We are live streaming on two channels at the same time. And today is going to be an awesome topic. We're going to bring you the top 10 dividend stocks from both of us, our top 10 picks. We should be live on two channels. And really a countdown, talking about the economy, talking about the talking about the stock market. So Kenny, how's it going, man?
I am so ready for this. I've been waiting. I've been preparing. I have my dividend battle list ready, and I think it'll be a great event. Now, for those of you that are watching on my channel, definitely check out Joseph Hoag's channel if you haven't yet. I'm sure you've seen his videos all over YouTube. He is a machine cranking them out and cranking out that value. So I'm very excited to do this collab with him, and we'll see who wins.
Nice. I didn't know it was going to be a win-lose kind of thing, but hey, I'm ready. I'm ready
It
to
says
battle.
battle. It says battle. So I
Yep.
mean,
All right, yeah, and for those of you coming to me on Let's Talk Money, check out Kenny Robertson's channel. Some great dividend stock videos there. But what I really like is Kenny's a master in real estate investing. In fact, last night when we were talking up this live stream, we talked a little bit about one of his favorite real estate investing strategies, which is investing in trailers and RVs and stuff. And something I've never looked into. I always loved real estate myself, investing, but I've never really gotten into that side or that property type. So we're definitely going to get Kenny back on on a live stream or on just a video collab to talk about that. Head on over to his channel after the live stream here, and make sure you tap that subscribe button and be a part of the community over there.
excellent. Yes, I'd love to have you.
So Kenny, I mean, this last week, I think was it Monday, the worst day in 2019 for the stock market, down 3%, and it's nothing new since May. We've had these huge up and down days, and
Right.
that's always kind of a warning sign to me that the market is on edge. It doesn't know what direction it's going to take, it wants to go, and one little tweet, I'll say, one little economic report could send it in one direction, whether higher or
True.
lower. So what are you looking at lately for the overall stock market, and how can investors position that before we get to those 10 stocks?
Right. And I think, positioning yourself is really important because, we always hear don't time the market, buy and hold, buy and hold. Well, that gets pretty boring pretty fast when you hear everyone repeat that over and over and over. So what's really important when we talk about investing successfully for the long term? One of the biggest things is making sure that your portfolio represents the entire economy, right? If you want low volatility, meaning not a lot of up and down movement in your portfolio, specifically the value of your portfolio, I always say make sure that your portfolio has a slice in every single part of the economy, not only US economy, but international as well, since we are a global economy these days. I think that's something where people tend to overlook that factor of making sure that they are truly diversified, not just heavy on tech or oil or real estate, simply because they have a bias. Right. For instance, I do a lot of real estate. That doesn't mean my portfolio needs to be crammed full of it, so to speak.
Sure. And in fact, if you've got a lot of direct ownership in real estate, I mean, maybe you want to get some indirect exposure through REITs or something like that. But you got to look at it as a whole portfolio.
Right. Overall.
You don't want too much in REITs also, because that's just adding to your direct exposure. So maybe diversify into other sectors. Yeah, I know it's something that we talked about a little bit about last night, and really diversifying across those different sectors, those different industries, and so important because the whole week I've heard nothing about the yield curve is inverting,
Yeah.
which I think is kind of code for the sky is falling. And in the past, it has meant that there was a recession, around 22 months out. I think
Right.
this time, anytime you hear somebody say this time is different, your ears should prick up, and you should get a little skeptical. But I think this time is maybe a little bit different. There are reasons to believe that maybe the sky isn't falling. Rates in Germany, okay, in all across Europe are negative, okay, and we're
Yeah.
talking government bonds. So the 10-year bond in Germany, people are paying the German government 0.5%. to hold their money for 10 years, and what that's happening is money is just flooding into the U.S., into U.S. treasuries, U.S. rates,
Yep.
and that's bringing rates down. So it's not necessarily everything that the economy is crashing down over here. It's just that, there's so many other forces pushing our rates down. Now that said,
Right.
it's hard to fight history, okay? Because the last 10 times that two 10-year-old curve has inverted, and that's what a lot of people are talking about this week. It's brought a recession, and I think I saw some data from I want to say Bloomberg this week, and 6 out of 10 of those happened within within about 3 to 6 months. The recession actually hit after that yield curve inverted, but another 4 of those happened 24 to 36 months. So, and the average ends up being about 22 months, and the market hadn't peaked in almost all of those. The market hadn't peaked yet. The market hadn't peaked. Has still had about 3 or 4 months until the market actually peaked
Of highs.
Yeah,
Right.
of the market highs. So don't think that the sky is falling right now. You have to sell everything right now. That kind of knee-jerk reaction, I think, is something that that doesn't do people any service with their portfolios. But we're going to get to those top 10 dividend stocks, the dividend stock battle that we're going to have, and then we're going to answer questions on both of our channels. This is very cool. If you're just joining us, we are live streaming on 2 channels at once, over at Kenny Robertson and over at Let's Talk Money, live streaming simultaneously on both channels. We're going to do a little dividend stock battle here, and then we're going to answer your questions from both channels. So, Kenny, do you want to start us off? What's your what's one of your picks?
Let's do it. So this one, I think I briefly mentioned on my channel once, but I've been very discreet about it. It's Hillenbrand, and it's a small cap dividend stock. Went public in 2008 of all years to go public. They have increased their dividend consecutively each year, very modest amount, just over 1%, 1 to 2%. They're an industrial holding company, so they own a lot of companies that provide major filtering components for the agricultural industry, food processing, material processing, major pumps for the petrochemical industry, a lot of different very boring but very solid and defensive type materials that they provide to all these different industries. Also, they own one of the largest casket makers in the United States. So it's a very modest dividend, but very solid balance sheet, good payout ratio, consistent increases. And that's what I want, right? Like, I'm not looking for the highest yield. I'm not looking for the biggest increase year to year to year. I want to see, right, the slow and steady wins the race, so to speak, right? So
Okay.
I'm not concerned with dividend yield tomorrow. I'm not concerned with it today. How is it going to be 10, 15, 20, 30 years? So Hillenbrand Inc. is my first pick.
What's the ticker symbol on that?
HI, like
Okay.
high.
And what's the the yield on it, the dividend?
Current yield, I haven't looked in about a week. Let me check really quick. I actually probably should have that written down. Let's see. It is, drum roll, 3.03. That is
Nice.
For my portfolio. I like that. Yeah, 3.03.
Yeah, I set up the dividend stock challenge portfolio that I'm running this year on the channel. That 3% was kind of the threshold for stocks going there. So solid dividend yield. The S&P 500 I think is at about 1.7%. So the broader market is about 1.7% dividend yield. So that's almost twice the dividend yield. And I think that the big picture, the important part here is to look at that total return and what that stock is giving you back, because you can find even some of the lower dividend yields, 2-3%. If they're
double
their
digits,
stock price.
yeah,
sure,
double digits, like Ecolab, companies like that, where I talk about that stock, and sometimes I hear feedback saying, "Oh, that yield 1%, 2%, what a joke!" But then you look at the total return, and it beats anything around. So so HI is my first pick, and you're right with the S&P, beats the S&P. A lot of the reason though is the S&P is getting full of Amazons, Apples, Googles, not paying a huge dividend on those, right?
Yeah.
So the dividend yield on the S&P is always going to be a little bit low because it has a lot of growth, but for the most part, HI I think would still beat that anyway.
Excellent, excellent. So Hillenbrand there. My first one that I'm going to start off with, and I'm actually going to start off with a couple of funds. Try to get you some broad diversification in a couple of themes that I really like, and then go into those individual stock picks. So I want to start off with VNQ, and subscribers to the channel will not be surprised at this because I love real estate. I talk about VNQ all the time. The Vanguard Real Estate Investment Trust Fund. That's the Vanguard REIT. Love real estate. Started out in commercial real estate as a commercial analyst in my college days, and have since gone on to manage my own residential portfolio and as a REIT analyst for a little while. It's critical diversification really for stocks and bonds, owning these REITs. I'm a big fan of direct ownership, so owning some actual property, but it's very hard to own different property types, properties in different parts of the country to really diversify. So this REIT, by getting this REIT, which owns 186 REIT companies, owns 186 other REIT companies that own properties all across the U.S., different property types. You're not only diversifying your stock and bond portfolio, okay, so you've got real estate in your stock and bond portfolio as well, but you're also diversifying that direct exposure into real estate if you have that. Extremely low expense ratio, 0.12% expense ratio, so very
Vanguard
low.
classic. Yeah.
Yep. It's a diversified property types and only 13% in the retail space. Now, we've seen this death by Amazon for the past decade or more. A lot of these retailers, especially these department stores and that are just going under. They can't compete. That's, a decade long struggle with retail. So it concerns me a little bit. I know a lot of dividend investors love Realty Income, which is ticker O, and I like it too. It's almost completely in that retail space. So good dividends there as well. But it's most of the stocks in that space are struggling. So I love this VNQ to give you a little bit more diversification into other property types. It's 3.4% yield, so strong yield, and a monster 25% return so far this year on that V&Q. This is one that returns have been very good. Now I don't want you to think those returns are going to last forever. People are going to rush into this and they're going to curse my name when those returns don't come out every month. Joseph, he said, and a lot of that return this year is from those falling yields, right? The yields coming down, and that's good for real estate because they leverage and they get those long-term loans, which anytime those loan rates are going to be so low, the return on this stock is going to be higher. But 40 years back to the 70s, this real estate investment trusts have gained 17% annualized. So it's a good long-term play, not just for yield and income, but also for that return diversification from your stocks and bonds portfolio and whatnot.
I really like VNQ for several reasons. One, it helps people diversify into a sector that they typically don't understand. Even, I would say, a moderately experienced dividend investor, even the payout ratios are different for REITs, right? Like if you look at a standard payout ratio for a REIT, it's going to be 100%, 150%.
Sure. Well, you can't really use the payout ratio.
Exactly, right? And so they're saying, I get that feedback saying, oh, why would you talk about that stock? It's having to use debt to pay its dividend. I said, no, it doesn't work like that. Yeah. Another reason why I like VNQ though is, it's a domestic U.S. REIT, but you have to keep in mind that those REITs, they rent their building or their land or their space to global companies or companies that do business all around the world. So kind of through that third party, I would say tertiary, you get global exposure, right? Like FedEx or like Realty Income, they own a lot of FedEx distribution centers. Well, FedEx does business all over the globe. So, it's interesting sometimes you're diversifying globally when you don't even realize it. So also within that VNQ, I know there's a company in there that owns a lot of Amazon warehouses. So you're going to get that Amazon play in there as well. So I like that. I like it. Yeah.
So what's your so that was number 9. What's number 8 on our list here?
Number 8 is Dover Corporation. So for those of you that have ever ridden in an elevator or opened one of those glass refrigerated or freezer sections in any sort of gas station, convenience store, Walmart, Fred Meyer, Kroger, whatever grocery store you're at, it's highly likely that that was a Dover refrigerator or Dover elevator. They make gas pumps, all sorts of different things that we touch and use and see every day. We just don't notice it, right? And so it was interesting. Just last weekend, I was in, I think, 3 or 4 different elevators, and all of them were Dover. So Dover has been around for a million years. They've increased their dividend, I think, going on 50 years consecutively. Dividend aristocrat, of course. And it's one of those out of sight, out of mind companies. They really have a strong foothold on all of their different products within all of their different industries. So they're very defensive. Again, very boring. It's not exciting. Not something that you're going to talk about at a barbecue by any means, but really good yield. Let me grab the most current yield on them really quick. Let's see here. But yeah, I really like Dover. And in there, in the elevator, if you ever look in the upper right hand, it should say the Dover, have the Dover logo. So right now they're coming in at 2.16%. So decent yield, but you have to consider overall total return, as well as they're pretty established, almost a $14 billion market cap. So just right there, you're getting into the larger, that's like a small, large cap. So very established, been around for quite some time. And again, I like those obscure companies that, you just wait in the weeds and get paid. So
Yeah, excellent. Love it. It's nice mid cap name there.
yeah,
One of those companies that has, I would say probably almost all of their or most of their revenue from the U.S. The U.S. economy is still they're calling it the best house in the bad neighborhood, right? Because Europe, China's slowing down.
yeah,
So yeah, a lot of times, when the global economy starts kind of struggling, but the U.S. is still doing well, you want to look for some of these U.S. industrial names, and yeah,
right.
I mean, I would have liked to. I don't know. They recently spun off their Apergy unit, which was like oil and gas equipment and industrial. And it was probably a good short term move considering the weakness in oil and gas lately. But I kind of liked it for that diversification around some of their other stuff.
Right.
Obviously,
I
if oil prices come back up, it would have really helped them. But it was probably a smart stability short term move. Yeah.
I encourage spinoffs. I mean, not blindly, but I really like spinoffs because when industrial conglomerates get too big, they get clunky, and they have their hands in too many different pots. So I really like that. Dover knows when to spin things off. In fact, Hillenbrand is a spinoff, right?
Okay.
And so and typically when companies do spin off, like there's a bunch of spinoffs from DuPont. So typically when those let's see, Air Products and Chemicals. They had a few spinoffs. Those spinoff companies do really well, right? Because they break out. They have one streamlined, business segment and business model. So I really like spinoffs, but I like when companies spin segments off, and I like spinoffs themselves. So
Awesome. Excellent. Okay, so that was number 8. Number 7 here, I'm going
right.
to take, and again, those of you on the Let's Talk Money community will find this as no surprise because I love this theme again. But the Alarian MLP Trust, and this is
Okay.
another fund, ticker AMLP. And what I like about this fund is, I mean, I like MLPs in general because they bring some great tax breaks for you. But when you invest in an MLP, you're going to get a K1 form, which is a
Yeah.
special
Pain.
tax form. Yeah, which I
Yeah.
mean, most tax software like Tax Act and TurboTax makes it easy to manage. Some people just don't like the extra headache. But if you want that without the K1 form, you invest in this AMLP, the Alarian MLP Trust. And what it is, it's just a fund of pipeline companies. Okay, it's a fund that holds hundreds of these individual companies that own pipelines. They own storage facilities, refining facilities. They own the midstream component of oil, right? When somebody pumps
Yeah.
that oil out of the grass, that's called upstream, right? That's
Yep.
your Exxon and a lot of those. Then they have to put it through a pipeline to get it to the refineries, or they store it in a storage place. Well, what happens, and this is a lot like what we saw in those real estate investment trusts that were set up in the 80s, special type of company that gets a tax break if they send most of their profits back to investors every quarter and every year, right? They pay
Right.
no corporate taxes on that on those profits. if they send most of it back to investors. So what
Right.
happened is this is a hugely tax efficient way to hold assets. Okay, if a regular company owned a pipeline, it would have to pay corporate taxes on the profits from that pipeline, send some money to you in form of
And then
dividends or
you
whatever,
pay.
and then you
Yeah.
pay it. So by rearranging into these MLP companies, they avoid that taxes, and as a result, they pay huge dividends. Any MLP is going to have huge dividends. This AMLP fund pays an 8% dividend yield, a huge dividend yield. Now, there's a caveat to that, okay? And if you look at the chart on the AMLP, you're gonna see this huge drop in 2014, 2015 when
Oh
oil
yeah.
prices crashed. Slammed in 2014.
Yeah.
Recently, again, as oil came down over the last couple of months. But I love this for that long-term yield and really the return to U.S. energy independence theme. Okay,
Right.
there's no denying that the U.S. I think it's the number one exporter of oil now. I don't know if it's overtaken Russia. I don't know if it's overtaken Saudi Arabia yet. But U.S. energy independence, exporting that oil, and really a major theme for the next few decades. And I think this really a huge opportunity right now. As the price of the some of these MLPs in this fund have come down. I did some research on the spread between U.S. Treasuries and then the yield on that AMLP fund. So your 10-year treasury rate right now is about 1.5, 1.6. The AMLP is 8%. So I looked at over history over the last 30 years. The spread, so that spread is about 6%, about 6.5% now, and I looked at forward returns on the AMLP. So what I found was that when the spread is so wide, when the AMLP is offering so much on yield and the treasuries are earning so little, then that forward return on the AMLP tends to be very high, tends to be double digits. And of course, what happens a lot of times is it's because people are searching for the yield, so they're going in, they're buying
Yep.
up those shares, bidding that price up.
Yep.
That I know it's hard to look at that chart of the AMLP in
Yeah.
2014, 2015, but their pain is your gain, and I think this is
Exactly.
a big opportunity to pick up the shares now. I own shares both in our 2019 dividend portfolio challenge and in my own personal portfolio, and yeah, I really like this fund.
So I love MLPs for income, right? They're called the toll booth of the energy sector, right? And
Absolutely.
so I think it's also important to point out that you're right. The U.S. has massive energy reserves. Also, we're very rich in natural gas. So when you think about these pipelines, don't just think like crude oil, right? Like WTI or Brent crude oil. Think about all the natural gas, propane. These are MLPs. They do the pipelines. They also do a lot of trucking. They do ship, right? So a lot of these master limited partnership. There's GPs, general partners, and limited partners, the investors. But the reason why I love these funds is because you really spread your risk out, among 40 or 50 of the big players in the MLP industry. And so I love this. Also, I tell people, look, this is a pure income play. Don't expect a lot of appreciation like you would a traditional dividend stock. MLPs are designed for income, right? Like Joseph was saying. So, and especially in 2014, you look at any MLP that has been around 2014 when oil fell off a cliff. That's just the name of the game, right? And so these MLPs will be a little bit less volatile than a direct energy investment like Exxon, or not, I shouldn't say Exxon, but like a traditional oil company, because typically these MLPs have long-term contracts, right? So whether, as the price of oil fluctuates, the MLPs don't really care. They're just here to transport it from A to B, and they have a specific price that they offer that service for. So I really like that. Have you looked at the Invesco Oppenheimer MLP fund? Like it's the Steel Path, and it's the no K1. They pay monthly. I think the ticker is MLPTX. I don't know if
Okay.
you've looked at that.
No, I haven't looked
Uh,
at that yet. I'd be interested to see what the expense ratio is on that, because a lot of these specialty funds,
High.
these specialty ETFs, you get pretty high, pretty
Yeah,
high
it's like
expense ratios.
over 1%.
Yeah,
Yeah, over
that's
one
tough.
percent. Yeah,
That's tough to
yeah,
get into
yeah,
something like that.
yeah. So very cool. Okay, so going similar. since we're on the topic of pipelines, I want to talk about York Water Company. This company has been around for over 200 years. They've paid consecutive dividends for over 200 years consecutively. We're talking through both world wars. We're talking they've been rewarding shareholders before the Titanic. Like it's amazing to think of a company. They're the longest consecutive dividend paying company in the United States. And so do they pay the highest dividend? No, but I respect them for their consistency, through generation after generation as the world shifts. You think about companies like Kodak, for instance, or like grocery.com, or all these big tech companies in the late 90s, or the stuff that was famous in the 70s and 80s. And as society changes, as technology evolves, companies suddenly disappear that were once household names. So companies that can consistently stay relevant and provide a needed service, which it's a small water utility in the northeastern part of the country, I believe Pennsylvania. And so they're so old that their original water pipes were actually bored out logs, so wooden water pipes, and it's just amazing. And so they've paid consistent dividends. Right now, their current yield is 1.81%, so that's kind of right in line with the S&P. But again, I love them for obviously the sector that they're in, providing fresh and clean water, which I mean we don't need to go into how obvious that is to essential to our lives, but as well as very defensive in the fact where utilities, they tend to keep pace with inflation, right? Because they apply for what's called a rate case to that municipality, and they vote and they increase rates. So if you want to turn on water within that municipality, you're paying York Water. So I really like them. Again, it's a big respect thing for me that a company can consistently reward shareholders through thick and thin, through all the different changes. So.
Yeah, that's amazing, that kind of
Yeah,
longevity in a company.
yeah,
I actually looked up, the annualized return, and I look at it in a microcap stock, 200 years, but they're still only in 48 municipalities. So it kind of hits, where's the growth? Where does it go from here? But somehow they've been able to produce consistent 15% annualized returns
yeah.
since '99. So the growth is coming from somewhere. They've been able to obviously leverage their balance sheet to produce that higher utility growth. It's amazing that a utility company can manage 50% annualized returns.
$400 million market cap,
Yeah,
micro cap. You're
yeah,
right. Yeah,
micro cap stock.
tiny. Hmm.
So definitely an uncovered gem, I think, in the stock market. One thing that kind of worries me is the PE. So this is ticker YORW,
Yep.
35 times trailing price to earnings. So I kind of wonder, how are they going to grow into that valuation? That kind of
Right.
worries me a little bit more. And I haven't looked at the stock for a while, but what are their growth plans? Beyond these 48 municipalities that they're in,
Hmm.
to do something that is going to grow them into that valuation and keep that 15% annualized return.
I
But
think that's
that's hard to
a
argue with.
Yeah, I think that's a good point. You want to, and especially with utilities, because it's not like they can just open up shop in a neighboring municipality tomorrow, right? And so
Mhm.
it does take time. One interesting growth point that they've implemented recently is they've always done fresh water connections, right? You turn on the faucet, that's from York. They haven't done a lot of wastewater, so they recently got into wastewater treatment, which has been really nice. And the CEO said, it's similar to providing fresh water, it's just at the other end of the pipe. So that was really interesting that they've done that. They've also been very competitive with well, I think a lot of water utilities are getting into this, or they will be if they're smart. Is they contract out their machines and their labor and their expertise to neighboring municipalities for replacing a lot of water infrastructure when
Mhm.
water infrastructure is owned directly by the municipality, because typically city governments aren't water infrastructure experts, so they hire these other direct utilities to come in and replumb and do things like that. So they've also increased revenue that way. And you're right. A lot of people do ask me about, well, what's a good time to buy in? Are they too high priced right now? And it's kind of funny because when people ask me about my favorite dividend stocks and they said, oh, like what's it trading at right now? I tell them I have no idea because I don't watch it, right? And so
Sure.
like I think that's kind of like it's just I log in quarterly and I look at the pricing, and typically like 2014, going back to those MLPs. I would hope that people that owned those MLPs in 2014, if they were taking income, I would hope that in 2014 they stopped taking income, started to reinvest to buy at that lower price. But typically, I just buy and buy and buy, and I'm not too concerned with share price, which people don't like when I say that, but it's just how I am.
Sure. Well, it's a good long term strategy.
Yeah,
Finding that handful of companies that you really like, you really think you really believe in that long term potential, and yeah, just continuously buying, and you're going to dollar cost average up and down, and you're going to do well.
exactly.
Awesome, excellent.
Exactly. Yep.
So for those of you still just joining us, we are doing our top 10 dividend stocks battle. Kenny Robinson and I simultaneously live streaming on two channels at once. Never seen this
Yeah.
before on YouTube. It's happening over on his channel as well as on Let's Talk Money on my channel. We are down to our bottom five. So the top five dividend picks. And these next two for me are going to be kind of the deep value dividend names that I love so much, but maybe a little scary over the short term. I really believe in these two companies, the long term potential on the price upside and the dividends. But as soon as I say them, you're going to say, oh, and as soon as you look at the charts, you're gonna kind of shake your head. But this first one, Western Digital. Okay, Western Digital is the
Oh
leader
yeah.
in computer memory storage. Okay, both on that traditional hard disk market and that new flash storage. Okay, so the hard disk market, the hard drive market has been struggling lately with the as customers shift to that flash storage. But Western Digital, they acquired another company to really bring them that flash storage growth. And then there are still some buyers for the hard drive market, which are kind of bringing in consistent, stable cash flow on that. This is a core component to computing, and really there's only two players: it's Western Digital and Seagate. So it's a duopoly. We love those kinds of names that they can control their industry, control their market. Now with Western Digital, it has rebounded 50% so far this year, but I think there's still some room for growth in this one, and it's going to be that long-term play as well. Pays a
Yeah.
3.7% dividend yield. That's ticker WDC, and it's rare in tech stocks that kind of a yield. So not only do
Yep.
I think this is a solid dividend name, a solid dividend payer, but I think it's a great way to diversify from some of those other traditional dividend sectors, right? What I see so often with dividend investors is they search for yield. Okay, they go to a stock screener and they search for stocks that pay a 3% plus yield, and of course most of those stocks that they find are going to be utilities, consumer staples, consumer goods, that kind of thing, and they load up on those. Well, what happens is they have a portfolio that is heavily weighted towards just those few sectors. And of course, what happens when something in the economy acts to weigh on those particular sectors? Whether it's consumer prices, employment, something like that. So I love adding these other sectors. These when you can find a technology company that pays great dividends, like Western Digital. I love adding that to a dividend portfolio. And actually, I did just recently add this to my 2019 dividend challenge portfolio, up 21% year to date against 15% return on the S&P 500. So got some great diversification in there as well as some growth.
I like that. And what's interesting is whenever you buy SD cards or thumb drives, a lot of that, you're right, is Seagate or Western Digital.
Yeah.
So they're big players in that, and that's really interesting. That you're right, you can get into tech, you can invest in tech and still have a solid dividend, right? Like typically when I think of tech dividends, I think of Microsoft and things like that. But that's a solid dividend for the tech industry. You're right on that. That's interesting. I like that one.
Okay,
You
so
know what's funny
what you
is
got? What? Go ahead.
that ticker. I can't. What's the ticker for Wells Fargo? What is it?
WFC. Yep.
Okay. For some reason, I'm thinking, wait, I thought that was Wells Fargo ticker. Okay.
Oh yeah,
All right.
WFC.
So
WDC is digital,
that's
and
right. Yeah.
WFC
Yeah.
is Wells.
Yeah. Okay.
Which I haven't looked at
Uh,
Wells in a while, but I've always been the kind of contrarian. So when the fraud cases and all that started mounting, I started looking at WFC as well.
Yeah. So what's funny about that, really quick, is typically people say, why would they continue to do that? That's they're dumb. They're going to get caught and they have to pay billions of dollars in fines. Well, they make more money. They'll pay the fine because they still come out on top. And I know that's terrible to say, but a lot of that I mean that it's terrible, but I mean they'll pay the fine and they've still made money.
Sure.
But it is terrible. I mean, I hate to Another thing that Wells Fargo has going for them is Warren Buffett, of course. But okay,
So what you
so
got for us? Number
this
4, right?
yeah, yeah. So it's a little bit related to one I've mentioned, and it's a little bit morbid, but hey, we're talking consistency and dependability, and a defensive sector is Service Corporation International, ticker SCI, and it is the largest. They almost have the entire market in the United States. They have their thumb on the market as far as burial and that final part of our life, and so. What's interesting about them is, yeah, they have caskets and they do traditional burials, and they own a bunch of funeral homes all around the U.S. They own actual cemeteries, graveyards. But why I like them and where I see a lot of growth is their crematory side of the business, right? So they own the largest crematory company in the world, essentially, at least in North America. And what's interesting about that is cremation is a lot less expensive than traditional burial. And so we see a trend, and this is really morbid, but I did a lot of research on it. And there's, industries that, or there's barometers out there within in that industry that says, hey, cremations are doing this, burials are kind of slowly doing that. And so not a lot of growth in burials, but that's what's really nice is they own the largest and I believe it's, I think they have like several hundred actual locations of crematories, and it's just the growth there is amazing. And of course, it's a defensive industry, and they actually had global business operations in the early 2000s, but they kind of scaled that back, and they found challenges because a lot of different burials in different countries have a lot of different religious traditions, and so they found challenges within certain countries, and so they really scaled back, focused on North America, and it's a really interesting. They also have another really interesting growth factor is the funeral and mortician and funeral parlor industry is a very mom and pop. It's very fragmented, right? And so mom and dad will start a funeral or a funeral parlor or some sort of funeral home, and the kids won't want to take it over. And so SCI comes in, they pay out the kids that just inherited this business that they really didn't want, and they come in and then they optimize it on a national level. With all the data and all the industry knowledge that they have, and so they've been growing like crazy. And again, they're really in the entire sector from A to Z. Current yield on them is only about 1.5, but again, you look at overall return and it's just killer. I think they're a mid cap. Let me check really quick. Mid or maybe a large small cap, 8.7 billion, right?
Nice. Okay.
So mid cap.
Mid cap.
Again, one of those really morbid companies, but it's just kind of one of those facts of life, right?
Excellent.
So
Yeah, I'm definitely seeing a trend in your picks. There are these super safe business models. The water utility with the last one, and then funeral services. I'm not sure. I'm not even sure taxes are as reliable as needing water and death.
Right.
So super safe. Yeah.
I always tell people, like, they say, you pick these companies that are just like, so out there. And I tell people, look, they're boring, they're consistent. But, it's like my fun is I take the income and the gains I get from those companies and I go do fun things in actual real life with it. Right. So my investments don't necessarily need to, excite me, so to speak. So,
yeah. And another one that has provided really, frankly, surprising returns. Looking at SCI. Since 2010, six-fold share price increase. 2010, so dividend yield maybe not quite as high as a lot of the others, but and here I was kind of wondering, okay, what are people dying faster than they were, or something? But it makes sense that those cremation services are probably really the growth driver in this. So that's
and it's interesting because to finish up on the stock really quick. People, at least in North America, are living longer, right? We're living longer and longer with each, medical advancement. Also, but where the population is growing, and so like when we talk about, water investments, waste like garbage investments, these types of investments, as the population grows, obviously no one lives forever. So it's an interesting investment, and and also if you go to their investor section of their website, they actually have a really easy to read investor presentation with their growth plan, with their model, with some really good, it talks about their compound annual growth rate. Really interesting. A lot of times when you go to the investor section on certain companies, they really don't have a lot of easy to digest data. This company does. So for those of you that are interested, check out their website in the investor section on that.
Excellent, excellent. So,
So,
3 more stocks coming at you. We're counting down our top 10 stocks, dividend stocks. Going forward, and we're down to the last three. Okay, so this last three, and this one it's going to be another. It's going to be another tough call, another pain point. But again, I really like the long-term potential on that, and that is Ford Motor Company, ticker symbol F. I know
yeah.
half of you just rolled your eyes, and the other half got a hernia from that. Or an ulcer, but I mean I think this is one of those deep value stocks that if you can stay in it, then it's going to have that long-term potential. Okay, it's down more than 40% over the last 5 years, but it's really the entire industry, right? We had all of those, the super low rates, the cash for clunkers program after the recession that just drove, 18. I think, new car sales peaked out at 18 million a year, which was huge, historic highs, records, and it was multi-years. So what we're seeing is just this huge backlog, all these cars coming off lease, all these cars, these new cars going to the used car lots, and it's really weighing on the new car industry. But there really hasn't been, a lot of major missteps by Ford management. Okay, so what I look at is I look at a company that still has a solid management, solid brand, and some potential. And 6.8% dividend yield. Okay, and it trades for under 7 times price to earnings, which is a low it's been bouncing around pretty much for most of the year and last year. Okay, so it's bounced around between 7 and 10 times price to earnings. On that long-term potential, I think the company is further along than the market's giving it credit for in electric vehicles, in self-driving. Ford expects to have 40 vehicles. 40 electric vehicle models rolled out by 2022. That's just a couple years away. It's got a strong lineup of releases this year and then the next. A redesign of the F-150, which is its most profitable truck or its most profitable vehicle next year. So I think that's going to be a big boost to those earnings, to that bottom line. It's up 17% so far this year. So I think the share price is starting to level out. All the bad news is already pretty much priced in. I think we're starting to see the entire industry kind of pick up, and it really reflects that long-term potential rather than, like I said, that near-term pain that it's been into. Earnings are expected to grow 7% higher this next year, which is huge considering what it's been through over the past few years. To about a $1.40 per share, and even a modest increase to maybe 8 times price to earnings would mean an $11.20 share price. So 24% gain on the share price from that 7 times PE to the 8 times and 1.40. And if it goes to 10 times PE, which is still pretty low and right around historical norms for this stock, that's $14 per share, which is about double where it's at right now.
Where it's at now.
Don't expect this one to be there immediately, but I think a lot of the people looking at Tesla and some of the newer car makers, they're going to get surprised at the electric vehicles coming out of Ford, as well as some of the self-driving cars over the next few years.
So I've owned Ford. I think it's one of the stocks where it's like I owned it before the whole crisis in 2007, 2008. I've seen it go down to almost, sub $1, near that share price. So what I like about Ford is people think, oh, it's a car company or it's a vehicle. No, it's a mobility company, right? And so I think people need to realize that. Also with Ford, if there was one boardroom that I could sit in for a meeting, just be a fly on the wall, it would be Ford. Here's why. Ford is a company that not only are they in the automotive market, they're really in the consumer retail market, right? People buying these vehicles, but they also have to have their thumb on the global economy, right? Because the products are sold all over, and specifically like utility vehicles, which, right, those are cyclical depending on how. So, it's a company that really looks at all economic factors, not, so they're not stupid, right? Now they are exposed to different economic, cyclical factors within their business model, but they have Ford F-150, best-selling truck ever, right? For decades and decades and decades, and they consistently refine and they consistently improve. And again, I know this has been said, it's like beating a dead horse. They were the only company that didn't take the bailout, right? And so it's just a really interesting company. And also, when you think about as big as company that Ford is, how agile they still are to this day. You think about how recently it's come out in the news saying, "Hey, we're no longer making any vehicles besides like one or two or passenger cars. It's all SUVs and trucks." And people say, "Why? That's so well because the demand is in trucks and SUVs, so they shift, right?"
Yep.
And so they've been really flexible that way, and
Yep.
I really like that.
Yeah, they've definitely made I've got a lot of respect for management. They've definitely made those hard decisions to really right the company, keep it afloat, and really making those long term decisions. So definitely.
Yeah, yeah,
So we've got two more stocks, two more dividend stocks. We are down
yeah.
from the top 10 down to the top two. If you just joined us, simultaneously live streaming this on both Kenny Robinson's channel and Let's Talk Money. Amazing. Never seen this before on YouTube. But so there might be a little bit of lag as we try to, do this on our, on both our feeds.
Yep.
But really cool, and I'm excited. We're down to the top two. What's your top pick for a dividend pick there, Kenny?
So one of my favorites, and I've mentioned this once on my channel. It's not known, it's not a household brand, but you have their products in your home right now. Maybe not in Colombia, but in the U.S. Flowers Foods Incorporated. Flowers Foods is one of the largest bakery companies or baked good companies in the United States. The reason I like them is how incredibly defensive they are. Let's take a look at some economic factors here. In 2008, this company, the share price dropped by 1%, right? What did the rest of the market do? What did a lot of household brand names do? They dropped by way more than 1%. So, it has a very low beta. Also, what I really like about the company is their suite of brands. You might not know Flowers Foods, but you know Wonder Bread, right? Wonder Bread enjoys a 98% brand recognition in the United States. And so, in other words, you take a sample of 100 people, 98 people have heard of or know of Wonder Bread. Dave's Killer Bread, they're getting into the organics, into those niche brands. Dave's Killer Bread is amazing bread, and it is a product of Flowers Foods. They've been snapping up those brands. And so also, you want to talk about margins, very high margin industry, the bakery industry, as well as these are the types of foods, right? Basic things like bread that people will continually buy even through a recession. They're not buying king crab leg. They're not buying filet mignon. They are buying loaves of bread. And so I really like that. The dividend yield right now is about 1.5%. Nothing to, write home about. But again, it's that consistency. It's, wait in the weeds and get paid every single time, year after year. And, live easy, get rich with these types of stocks.
Sure. And that's what's the ticker symbol on that?
FLO, yeah, FLO, yeah, FLO,
Yeah,
flow.
solid. And you look at it, and 24 times PE valuation isn't horrible for the packaged food industry. What we've seen over the last few years, especially with yields at historic lows, is that people are just rushing into these consumer staples and packaged foods stocks, obviously driving the price up and the price earnings ratio. But 24 times isn't bad for that kind of stability. And I love this one. What I love about this list so far is it's a great mix of stability from Kenny's picks. So you've got some funeral, water utility, consumer goods, great stability there, and then some kind of scary ones that I've put out there with Western Digital, with Ford, some stocks that are going to be a lot more
Some
risky.
juice, juice.
But eventually I think are really going to add that juice, add that return to your portfolio.
Right.
So we have got one more dividend stock left, and then we're going to get to your questions. We're going to do a round robin Q&A. So questions from each channel, from both of the channels, and I think that's going to be the best part of the video so far. But this last one I wanted to add here as an alternative. Okay, an alternative to AT&T. So I'm picking Verizon Wireless. That's ticker VZ. And why I picked this again is because I see so many investors loving AT&T. Just about every dividend investor I think in the world loves AT&T, but it scares me a little bit. And I'm going to tell you why first, and then we'll talk about Verizon. But AT&T, it's got this huge debt load from that acquisition that's really going to limit the cash flow and flexibility. And I think they're going into a time where with that TV streaming service that they're competing against Disney Plus, against Netflix. That is expensive. If you look at how much these other companies, Disney, I think Disney's paying, spending 15 billion on its Disney Plus streaming
Yeah.
content. Netflix is right up there, 10 to 15 billion. So I think AT&T is going to find it's going to cost a lot of money to create this content for its streaming service. And that's besides just the telecom space that always is very capital intensive. Trying to get that 5G infrastructure network up is going to be very expensive. So with this huge debt load from the acquisitions for AT&T, I think it's going to be very difficult. It's going to limit cash flow and their flexibility, and it's going to kind of weigh on the stock. And related to that acquisition of Time Warner might not go as planned. Time and again, we see these companies try to bite into huge acquisitions. Okay, they buy these huge mashups of companies like we had here with this AT&T and Time Warner, and it's difficult to put two companies that are that large together. So a lot of times, the sales, the efficiencies and the earnings don't come out quite the way they thought it would. And of course, that again is going to limit cash flow, going to limit flexibility to stay competitive in, frankly, these two very, very competitive sectors and spaces that they're in. The streaming, the telecom, which I love the growth in telecom with that 5G, but it's going to be competitive. I'm not saying that the dividend for AT&T is in any real danger. I just don't see the stock price or the dividend growing as much as people are expecting. Okay, you're gonna get that maybe 6% dividend yield that you have on the stock, and that's great. But I just don't see it growing commensurate with the risk. Okay, one of the biggest things that I try to talk about is looking at these high dividend yield names. You have to look at risk and return. Okay, so
Right. Exactly.
some of these stocks have a huge dividend yield, 6-10% or more, but what's the risk in the company? Very high risk.
Right.
Whereas, especially some of the ones that Kenny's talked about, very low risk, almost no risk, right? Very stable cash flow businesses, a little bit lower dividend yield, but very stable, good stuff. And I see everybody rushing into AT&T. Everybody loves AT&T. I want to give you an alternative, so that's why I'm picking Verizon.
Yeah.
It's the largest U.S. wireless carrier, okay, and more really of a telecom pure play than AT&T is, since AT&T has moved into that, basically everything, TV and internet. I love the telecom space with that 5G growth coming out over the next few years. So way more positive on that. Verizon does also have a stronger balance sheet, and it's ready to use it to take advantage of that wireless growth. Okay, they don't have that huge debt load that AT&T does. Also has a solid 4.3% dividend yield, so maybe a little bit lower than AT&T, but still a very solid dividend yield, and it's actually beaten AT&T on that total return over the 2 and the 5 year period. So quite a few of those different periods. So don't just look at at the dividend yield of a stock. Look at the total return that you're getting, as well as that cash flow.
And I like what you say about, higher yield, but what's the risk, right? So, 4 you say 4.7, 4.5% yield on Verizon?
4.3 on Verizon. Yeah, a little bit higher, 6%, 6 something on AT&T.
Right. So you look at, the difference of maybe 1.5% dividend yield or around there, but Verizon has higher risk adjusted yield, right? You're taking, much less risk for not that big of a pay cut. And also, I think AT&T got lucky that they got so big and established before they took on all this debt, or else it'd be a lot scarier. Also, like you said, you look at the chart of AT&T and it's this. I hope no one owns AT&T for growth, and I think most of the board at AT&T knows that people in their stock for income. So I think it's important that they keep that going, and I think they know that as well. But you're right. You get into these big leveraged debt loads on your books going into a potential slowdown in the cycle of the economy, and Verizon might be a better play, over the long term. So I think that's an interesting alternative. And you're right, because a lot of people AT&T. So
they love it. I mean, 6% dividend yield, and you might get another couple of percent on the share price over the next few years. So maybe 8-9% total return. But I think that's kind of a top end. That's kind of a best case scenario, 8 or 9%. And what's the downside on that? All these things with the debt load, with the acquisition, all those things. So many things could go wrong. Whereas I see a much cleaner trajectory for Verizon. So just a an alternative to maybe think about going into something else. So that's our top 10 dividend picks. Some awesome names, some great names. I think some excellent stability and long term growth. Now we're going to take your questions from both channels. Again, we're live streaming on both channels at once. So this is really cool. We're going to get to see questions from Kenny's channel, questions from my channel. I'm going to kind of scroll up through my chat. If I didn't see your question, then ask it again in the chat window there. We'll try to get to your questions. Kenny, you want to go? You want to go first?
Yeah. So I'm scrolling through right now. So if you have questions, definitely get them in. Just like Joseph said. So I'm scrolling. There's a bunch of people talking amongst themselves about the stocks that we've mentioned, which is really
that's
cool.
one of the best things I love about this live streams or just YouTube in general is you get this community of people together in a channel, subscribers, community members, and they talk back and forth, they exchange ideas. I love the comments that I receive every on all the videos. Lots of great ideas for videos and things. So yeah, love it. Again, go to Kenny's channel, subscribe to that channel if you're coming at us from Let's Talk Money, and and make these communities even stronger.
So I have a couple questions that came up, so thoughts on TERP is the ticker. It says, I read an article saying they would be a good dividend stock for the next decade. Ticker TERP. I've never heard of it. Let's check it out. So TERP. Okay, Terraform Power. So is it a power utility? Okay, let's see here. All right, it is so it's a small cap, very low beta, 3-month beta. So meaning for those of you that are just tuned in, beta is a major volatility, meaning how violent the price moves up and down. So the lower the beta tend to be the better. Decent yield as of right now, 4.76%. Let's take a look at their chart long term. So it looks like they dropped off a cliff in 2014, if I'm looking at that right, or excuse me, 2015.
Yep. Well, what you get is it's mainly a clean energy provider, right? So a lot of these alternative energy ones, they do solar, wind, a lot of this space, and obviously, when oil prices come down, then the driver for that clean energy comes down as well. Okay, clean energy, all the environmental benefits aside, it's mainly driven by that alternative cost to power. So if energy providers and producers are looking at very cheap oil prices and natural gas and that kind of thing, then that incentive to switch to some of these cleaner fuels kind of goes away. Now I do like that they've got projects, across the developed world. It looks like is U.S., Canada, Spain, Chile, Portugal, the U.K. So a little bit more diversified than you would expect from a lot of the energy providers, those regulated utilities.
They have negative earnings, so they're not making money, which is an issue, especially if again we're looking at alternative energy sources. We're looking at a lot of different risks on the global macro front, so to speak, generally speaking. So me personally, I probably wouldn't buy into this right now. Not saying that you should always wait for everything to look rosy before you buy in, right? Sometimes it's nice to be the contrarian, but with them not making a profit, it's tough for me to buy in.
Yeah. I mean, if I'm going to invest in a utility, a regulated power and that kind of thing, I like to see a little bit more stability. I mean, I understand, with clean energy, most of these are younger companies and that kind of thing. What does worry me as well is the size. $3.5 billion market cap, so it's a very small one. And without looking further into the balance sheet. And where it's doing business at specifically, that would be kind of a tough one. And for a 4.8% dividend yield, it's not something that really trips my trigger, so to speak.
Right.
Okay. So now I've got a question from Michael Jones. and love the back and forth we're getting. Actually had I don't know if he's still there, but Bruce Wang was in the chat here earlier. Another great
Oh,
dividend
cool.
channel.
Yeah.
As well as a lot of the people that I see every week. But Michael Jones wants to know about Main, Main. I believe that's
Oh, yeah.
Main Street.
Capital, Main Street
Yep,
Capital, something
and
like
it's
that. Yeah.
yep, and it's a BDC, so business development company, right? And typically these are kind of in the same space as those REITs and the MLPs. They put out almost all of their profits to investors. So the dividend yields are going to be very high, often very attractive. What you got to worry about in these BDCs is the management structure. Okay, so you'll find two types of management structure in these BDCs, these business development companies, and they'll either be internal management or they'll be external management. Okay, and the internal management is usually less costly, right? And their pay structure is aligned with investors, right? What happens is you get external management structures where they have an external company managing this BDC, and their pay structure, it depends on kind of like projects and the risk return on specific projects and stuff like that. So they're looking at very risky projects to make that home run, right?
Yep.
So the risk is higher. It tends to be much more expensive, much higher expense ratio, and that you're paying for management on these companies. Main Street, haven't looked into that one for a while, so I don't know what the management structure is on that. I can't tell you. I mean, it's a fairly large BDC. It's been around for quite a
Yeah.
while. 5.8% dividend yield, so it's a strong dividend yield. And just looking at the chart, it's a little bit more stable. It's a little bit more stable, steadier price rise than a lot of these fly by night BDCs. So this is definitely one I would put on
Right.
the list. I think another good one. Another good one as far as BDCs. What's the other one that I always see a lot of times? People like was a Prospect Capital Corporation, which I think that's actually an external management. So actually, that's one that I tend to stay away from.
Yeah.
So comparing the two.
I PSEC, right?
Yep.
PSEC.
PSEC.
Oh,
Yeah, that's one I try to
no.
avoid a lot of times when I
Yeah.
hear it mentioned. But Main
Mm.
Street Capital Corporation, it's a good BDC. With these BDCs though, and again, if you're just looking for dividend yield, this is going to be more important than which stock you pick, any particular stock. But the idea of when you're looking for dividend yield, don't just pick the highest dividend stocks with the highest dividend yield, okay? Because what you're going to do, you're going to end up with a portfolio of just BDCs, REITs, and MLPs.
Yeah.
And these are three sectors or three business types that are highly exposed to interest rates. Okay,
Yeah.
all three leverage their business model with interest rates. So they borrow short term, lend out long term, or buy longer term assets. And that's great when interest rates are dropping, as they have been lately. But when interest rates rise, then these business models really start to come under pressure. I still like them long term for long term investments, so definitely pick up a few of these as a long term investment. But you have to be worried. You have to be wary of filling your portfolio with just these kinds of companies. I like Main Street. Fill it with a good portfolio mixed with some REITs, some MLPs, and some of those consumer staple stocks that Kenny's talked about. Some of them a little bit more stable companies.
Yeah, and with BDCs, I mean, they're inherently more risky. They just are.
Mm-hmm.
And that doesn't mean that all of them are bad, but you just have to understand what you're getting into. Business development companies is kind of in the name. So they take money, they buy in, they either loan or buy in equity stakes to these mid-sized companies, small to mid-sized companies that typically don't have, I don't want to say don't have alternatives, but typically, they have to borrow at higher rates. Maybe their balance sheet doesn't look amazing, but they have some growth prospect within them. And so I think with BDCs, it's really important to look at how they've done this past 10 years of bull market. If they haven't performed well in the longest bull market that the world has essentially ever seen, how do you think they're going to perform going into a recession,
Sure,
right?
sure.
And again, I keep saying that, so I'm not meaning we're going into one, but if they can't perform well in a bull market, I mean, you have to be on Mars to think they're going to perform well in a bear market.
Yeah, yeah.
So that's, I think, is a huge indicator for BDCs. If they're not giving you good performance now, when will they?
Yeah,
Right.
yeah, and
So
that's why I try to stay into the larger established names. These things. Okay, since the recession, banks are still once bitten, twice shy, so they're not lending out to a lot of these small and mid-sized businesses. So these business development corporations, these BDCs, have just boomed, right? Because that's their key market. But
right.
yeah, they're the vast majority of their business is loaning out money to these small and mid-sized companies. Well, what happens when a recession does come? Then
Right.
these small and mid-sized companies have a higher failure rate. So not only do they have problems with the yield curve and that kind of thing, but these BDCs tend to see a larger amount of their loans defaulting in
They're
those.
leveraged.
Yep,
Yeah.
yep, they're highly leveraged.
Yeah.
Now I've seen
Yeah.
a couple of questions. I want to real quick reiterate our top 10 because I see a lot of people just coming into the
Oh yeah.
into it. So let's go through the top 10 real quick, and then we'll get back to your questions because I love this kind of round robin,
Yeah.
taking questions on both channels. So Kenny, start us off. What were your 5 dividend stocks that you had and the ticker?
So my 5 dividend stocks were Hillenbrand, ticker HI, Service Corporation International, ticker SCI, Flowers Foods Incorporated, ticker FLO, Dover Incorporated, ticker DOV, and last but not least, York Water, ticker YORW.
Okay. All right. So we
Yep.
had Kenny's 5 there. Mine were here.
I had to
Mine
read
were
those too.
VNQ, so the Vanguard Real Estate Investment Trust, the AMLP, so the Alarian MLP Trust there, the WDC, which is Western Digital, the Ford, which is ticker symbol F, and what was the last one? The last one was Verizon, ticker symbol VZ. Okay, so let's so what's your next question there?
So I'm getting a lot. Let's see. How do you determine what percentage of your portfolio to put in each investment? So I think that's a very personal question, but I think there are some rules of thumb, so to speak. And so I always say that you never want, and this is, I think this, like I just said, it's a pretty general rule of thumb. You never really want any more than 5% of your overall portfolio invested into one company. And it's really easy these days to, I mean, you could buy one ETF or one exchange traded fund and be completely diversified and never have to do anything. So it's very easy these days to diversify away that risk. So there's no reason that anyone should be investing very concentrated. So I would say that I even have like favorites where I try to check my own investor bias and say, hey, I really love waste management, but it's outgrown its position size. I need to trim back a little bit and harvest some losses somewhere else to offset any taxable gain. Another thing that I look at is people think that, okay, well, my brokerage account is this, my Roth IRA is this. No, I'm talking your overall portfolio, not even publicly traded portfolio, your rental properties, your business loans that you've may have loaned out to different companies, everything, your overall portfolio, everything that you, Joe Smith, are worth. You need to say, okay, am I too heavy in rental properties? And I need to scale down on my REITs or sell a rental property. Am I too heavy in tech? And so you need to look at your overall portfolio rather than just per brokerage account or per account. Your overall wealth, your overall net worth. You want to be diversified.
Mm-hmm. Yeah,
I would say.
I love that idea of max 5% of your portfolio in any one individual stock. That's that's going to give you make it so you can get those extra returns on companies you really like, individual companies. But it means that one company isn't going to destroy your entire portfolio.
Yeah.
Okay.
Yep.
Love the idea of a portfolio wide view. So looking at all of your wealth together, and really starting with the asset classes. Okay, so how much of your total wealth is in stocks? How much is in bonds? How much is in real estate? And I think what a lot of people look at when they invest is they just look at stocks and bonds, right? Or maybe they think that real estate is kind of a direct ownership kind of thing that they have off their portfolio. But I really think you need to take advantage of REITs. Real estate investment trusts trade just like stocks. Easy way to get your exposure to real estate. Combine that in with your stock portfolio. Okay, so when you see people saying that you should have 70% or 80% of your money in stocks and 30% in bonds. The common rule of thumb is like your 100 minus your age is supposed to
Right.
be in stocks, right? Well, that never
Yeah.
includes real estate, right? So we have
Right.
so many people running around with 70% of their money in stocks and 30% in real estate or 30% in
Yeah.
bonds and no real estate exposure whatsoever. Okay, you know what? Like we said, the REITs, that REIT sector has provided a 17% annualized return since the 70s. Okay, that's more than stocks, but it still has that diversification that you need. So I think balancing between stocks, bonds, and real estate is really important. Like Kenny said, it's going to depend on your age, your goals, and your own personal risk tolerance. Whether you get
Yeah.
freaked out, when stocks rise or fall. But I think most people can have right around 50-60% of their money in stocks. Another depending on what your outlook is for the economy and your own goals, but 20% or less in bonds, something like that, and then the rest in real estate. So having that more diversified picture than just stocks and bonds, very important.
And really quick to kind of to add on to what Joseph just said about REITs or physical real property. Sometimes people think differently about both, and I think a big thing, and this is probably, I mean, I even see advanced investors or experienced investors talk about this, which kind of surprises me sometimes, is they're consistently comparing REITs to owning property direct. These are two different animals, very different types of investing. Okay, you can't. It's comparing apples to oranges, right? I talk to people that own, traditional single-family homes physically in person, and they say I get way higher returns. I can physically touch my property, X, Y, and Z. And I say, yeah, but you have to either deal with phone calls or pay a management company. You're concentrated to one specific market. There's a lot more that you have to do in person, or you have to pay a management company versus, excuse me, sorry about that, versus REITs, lower income potentially, but 100% passive. So again, also diversification, getting into things that you might not have experience buying personally, buying $1,000 versus of a REIT versus spending 100,000 on a small rehab. So again, they're very different, and I continually see compare and contrast to these different things, and they're just different, right? You make less with REITs, but it's a way different animal. So I always like to bring that up when we start talking about real estate.
Yeah, love these. I love these broader questions. Not necessarily just which stock to buy, because I think it's so important. That how you invest across different asset classes. That how you invest is so much more important than the what of investing. Okay, so excellent questions. Next question here from I'm going to butcher the name, I'm sure, but Christ Wong, right? It asks about ADM. So this Archer Daniels Midland.
Yeah.
It's a agricultural commodities. So they buy, they transport, they clean a lot of these agricultural commodities like soybeans, corn, oil seeds, that kind of thing. And surprisingly, over the last couple of years, when the agricultural market has really been hurting on the trade war and on different things, a lot of these commodity prices have been coming down hard. ADM's done pretty well as far as stock price. It hasn't crashed like a lot of these other ag related commodity companies. Pays a 3.8% dividend yield. And I mean, I kind of like this one. $21 billion company, so it's large, established. I haven't looked at the balance sheet, so I don't know how leveraged it is. But it's a fairly large company, diversified, and if you're looking at these longer term plays, I really like the agricultural space. It's going to be tough for the next couple of years because we're still seeing weakness in those ag prices, and the pain isn't over. Okay, even as you see weakness in those prices, that bleeds into farmer debt loads. The equipment companies like Ford, or not Ford, but John Deere and Caterpillar, see less demand on their farm equipment. So I definitely think there is more pain to come for the agricultural companies here in the next year or two, as the whole theme starts unwinding. We're starting to see, especially in my home state of Iowa, and then some of these Midwestern states, these grain silos are busting at the seams. Okay, they are storing this, hoping for a better day to sell these corn and soybeans and stuff. So the supply is way up. China is now boycotting, I guess you could say, the ag commodities in the U.S. So the demand is down, and that's just going to bleed into across the agricultural market. But if you can take a longer term view, if you can withstand the pain over the next year or two, we're only eating more. Okay, exploding global population, and not only that, but people are in these emerging markets, these other markets. They're eating more meat, which of course means more grains and feedstock for the animals. And what you look at is, if you look at some of the projections or the food needs projected by places like the UN and that kind of thing, then there is no way to get to the amount of food we need, the supply of food that the globe is going to need over the next 20 years, without using some of these fertilizer companies and that kind of thing. The crop yield just isn't there. So I like ADM as far as a kind of a broad play on it, but I think if I was looking at the ag space, I would maybe look at maybe the fertilizers a little bit more for that longer term play.
Yeah.
I don't know, Kenny, what do you think about ADM?
So I made a video on ADM actually probably about 6 months ago. I own it. I'm long ADM. I own it for the long term though. All of this fluctuation in the past couple of years, I mean, that's just part of the game, right? That's long term investing. With that being said, though, I think fertilizers, companies that specialize in crop advancement, different seeds, and specifically with that, you look at like Bayer, Monsanto, they have some issues with their Roundup lawsuits and things like that. But overall, on a macro view of the industry, you're right, global population is growing. Arable land, right? So like land that is suitable for farming and crop production is shrinking because we have these cities expanding, right? With population, more strip malls, more apartment buildings. So there's less actual farmland every year. That's a depleting resource. So, you want to talk about valuable investment, talk about farmland that has plumbed water. Also, a nice macro investment for that sector is the iShares Ag ETF. It is a ticker VEGI, Veggie. Okay. It owns the entire. I mean, you can do that one ticker and have the entire thing in your pocket. Yeah. So that's my opinion on that.
Yeah, I like that one. There's another fund, the MOO. The MOO. Agribusiness. I think it's a little bit higher expense ratio. So of course, always look at the expense ratio on the funds before you buy. So yeah, definitely. So what's your next question there?
Let's see, there was one. Let me see if I can scroll back up and see it. They were asking, and I guess I should say the screen name or whoever puts it out. I lost it. Let's see. So they were asking, is it better to buy a bond fund versus individual bonds? And if so, what are some good bond funds? Mm-hmm. And so it's kind of either this or that type deal. So if you know what you're doing and you know how to look at yield to call, yield to worst, and really know how to analyze an individual, say, corporate bond, and you're comfortable with the ratings and everything like that, then sure, pick individual ones, knowing that the bond value may fluctuate widely, although you're still going to get that coupon, right? That interest payment. And all you care about, you don't care about the fluctuation unless you're going to sell the bond. All you care about is the income. So just keep that in mind. The fact that it's a bond doesn't mean it's not going to fluctuate. You just care about that maturity date when you get your $1,000 back par, right? So make sure you don't overpay if you're going to go individual. Watch the ratings, even though the ratings aren't always accurate regardless of that. And just try to get a good price. But if you try to get a good corporate bond in this particular market right now, you're going to pay a pretty penny for it. You're going to pay a premium, which means over par value. Meaning, if it's $1,000, if it was issued as $1,000 bond, you might pay like $1,100 or $1,200 for it, which pushes that yield down because the coupon stays the same. So conversely, I like bond funds. And people can talk about interest rates and yield curve and different parts of the economy and cyclical things. But as far as long-term investing, I really like the PIMCO Income Fund. I think the ticker is PONPX. PIMCO income has been pretty cool. I really like Principal Global Diversified Income. It has not only bonds of both municipal and corporate, it has some preferred stocks in there as well. Preferred stocks are like the cousin to bonds and stocks. For those of you that might be unfamiliar with them, I'm really a huge fan of preferred stocks. I have a whole portfolio full of them, and they're kind of like the best of both worlds. You get a little bit more. I mean, I don't want to use the word growth, but you have more upside potential with preferreds, a little bit higher yield. So it's all it is. It's like a safer stock, essentially, is what a preferred stock
Yeah.
is.
Yeah,
So
I like preferred stocks. Really, in that heightened market volatility. So when the market is falling, the economy is sluggish or falling, and people don't know where the economy is going. Those preferred stocks give you the safety of a bond, and then the convertibility. You can convert those preferred stocks into shares later on. If the
yeah.
company when the company does well. Now, what I've always thought, what I've always heard, when you're deciding on a bond fund versus versus individual bonds, it's really the cost of what it's going to cost you to invest in a lot of these. Okay, so if you're looking at putting together a diversified portfolio of bonds, which is really what you need, you don't want all your money in one or two different bonds from a company because again, what if that one bond defaults? It's that same idea we talked about with no more than 5% of your portfolio in a single individual company, right? So if
Right.
you look at the cost, it's gonna be to put together an individual bond fund. Okay, we're talking 100,000 plus
Yeah.
in individual bonds. Okay,
Right.
because
Yeah.
you need different sectors. You need companies in different sectors. You need companies at different places on those ratings. So different rated companies. You need different maturities. So it gets really difficult if you don't have 100,000 plus to put into bonds to build a diversified portfolio and keep those costs down. Okay, because you're paying those broker commissions on every bond you buy. So you want to buy 10, 15,000 or more in each bond. So yeah, what I always tell people is unless you've got that 100,000 plus to put into individual bonds, then go with the bond fund. I like the BLV, which is Vanguard corporate bond fund. Very good yield on that one. They're all longer term bonds. The AGG is another good bond fund. So some solid bond funds that you can buy, and a lot of these bond funds, they're up 10-15% this year, which is not normal for a bond fund, okay, or
No.
for bonds. So again, when we get to next year and rates start going up, or the year after that, don't curse my name because I told you to invest in BLV, because that 15% return isn't going to be every year. You're not going to get that every year. You're going to have some weakness,
Right.
but it is going to protect your portfolio from the from the ups and downs of stocks, and it's going to be that stable cash flow. Got a great one here from A Gaz. So A and GAZ, great member of the community. She's always on the live streams. I appreciate that. She
Cool.
says she's opening an M1 account for her goddaughter. Should she invest the lump sum all at once or over a small amount regularly over a few months? And this is the big question for a lot of investors right now, right? The stock market is going crazy right now, ups and downs, roller coaster. Should you just put all your money in there, or should you maybe wait for better prices? And again, it's a personal decision. I think, especially if you're talking about your goddaughter, she's got decades to invest. So just put it in there and don't worry about it. She'll if she's investing regularly in that, or if anybody's putting some money in there regularly, it's going to be investing at the highs, investing at the lows, and it's still going to be an excellent return. I love this idea of opening up even a small account for grandchildren, for goddaughters, that kind of thing, because it's really going to take advantage of that long-term compound interest. What I will say is that don't just think about stocks. Again, maybe put 20% of the money into some bond funds maybe put another 20% into a REIT fund or some REITs. And then, yeah, if the market does continue to fall apart, which there's a very good chance it could, then you've got that dry powder, right? You can take that money out of bonds and real estate, which will probably have done well because interest rates are going to continue to come down. You can take that out and readjust it back into your stocks for that lower price. So it's kind of a best of both worlds, right? You're not necessarily putting all your money in stocks right now, but you're getting a good chunk. You're still getting the returns, and it's not sitting there in cash. So great question there from A Guys.
Yeah, and I would have to agree. I would say, if you're thinking about either waiting to invest or investing, I would say definitely don't wait. You can sprinkle it in the market for sure, but if your goddaughter does have a very long time, the price she buys it at is going to be kind of lower on the totem pole as far as priority, especially after decades of compounding. I mean, again, purchase price, of course, as low as you can, but you can't really time the market. As far as diversification, just like Joseph was saying, one really cool option, and this is what I do for my godson and my little nephews, is I have some big names in there that they can like relate to: McDonald's, Coca-Cola, whatever. But the lion's share of their portfolio is in single ticker solutions like AOM, for example, where, and what I mean by single ticker solution is you buy this one fund and it has you spread out among US, global stocks, bonds, all different sectors. I mean, it's really a nice overall investment. So
So what you got next? Next question here. I'm loving
let's
this.
see here. We have, okay, gosh, so many I'm trying to get through. Let's see. Global macro view. I am bearish. What do you guys think? Well, and this is where people always like, they feel like they're getting gypped from my answer. Like they feel like I'm not answering it enough. But here's like my opinion on global, and like what is, I don't care. And I know that's like such a crappy answer. And I should give a better answer, but it is true. And here's why I don't care. And I think if I can provide some more context that way, I have set my portfolio up to where it doesn't matter what economic cycle we're in, I'm always making money. That doesn't mean that the value of my portfolio isn't going to fluctuate, but I'm setting it up and I realize that this money, I can draw on it now, or I can reinvest for the next 10, 20, 30 years. So I don't try to time the market. If you ask me about my favorite stocks, I don't know what price they're trading at right now. And I know that's such like an empty answer, but I just don't care. And I know that's terrible. But I think if more people, I think it's important to stay up to date with the markets, learn about the economy, and be educated. But at the same time, it's also nice to be at a level, and anyone can build their portfolio this way, to where you don't necessarily have to lose sleep over what next year will bring. And that's kind of like, I know people hate my answer to that, but yeah.
Sure. And you know,
So
I followed a little bit more as an economist for the state of Iowa, so I've always loved following the market and that macro feel, because I think that's the big opportunity really is following the
yeah,
business cycle.
yeah,
Nobody. Okay, so you've got a handful of people in history: Warren Buffett, Peter Lynch, that can actually pick stocks from the ground up. But the easier way is to start at that macroeconomic level, start from that high level, and see where the economy is going, where are these sectors going, and then just picking the best stocks within individual sectors. As for myself, I mean, I'm a little negative as well. So, and this doesn't necessarily mean I'm selling stocks, but it does mean that I'm have more in cash. I've covered some of my positions with covered calls, right, which is just selling a call on your stock you own. Some of the more cyclical names. So I'm a little bit more in cash, a little bit more in bonds, and really holding that dry powder. I've enjoyed the last 10 years of stock gains, great stock gains, great returns. So I'm a little bit more hesitant to put my money in here, and that's just because you're seeing Germany, I think, is in a technical recession, which is the driver of Europe, the economic driver of Europe.
yeah,
Europe's not looking good. The UK is most likely going to have a hard Brexit come October 31st, which is going to hit the economy over there. The China's economy has been the driver of the global economy for more than a decade, and that's slowing down. The tariffs aren't helping any. And here in the U.S. has really, like I said, been the best house in a bad neighborhood as far as the global economy. And what we're seeing is warning signs there as well. We're seeing we're seeing companies just load up on all this cheap debt, which of course is going to be a problem if interest rates rise. I think that the tariffs are going to come through in I think the tariffs are going to come through in higher inflation over the next year or two, and that's going to limit what the Federal Reserve can do as far as cutting rates. I think the market thinks the Fed's going to give them that juice in a lower rates, and I don't think that's going to happen. So yeah, I mean, I wouldn't necessarily say that you should be selling your stocks, but definitely new money, put it in cash, put it in bonds, and and just kind of hold on, I think.
Another interesting thing, when we talk about slowdowns and what are the triggers for moving into a recession, and a lot of it can be non-material items or events. Like if you're a CEO of a North or any company around the world, you're reading all of this stuff about, troubled waters on the horizon. Are you going to go out and hire more people? Probably not. You're probably going to start hoarding cash. So even though the business environment might be good, just because you, as the driver of your ship, right, the CEO of the company, feels, shoot, I don't want to get caught with my pants down if we go into a recession. I better slow down on the hiring. I better slow down on the ordering of materials. So it could be all just a non-material event of companies getting scared. So they start, letting off the gas. And that's what turns us into a recession, is everyone just letting off the gas.
Yep.
So there's a lot of different things. And with economics, it's really the study of people, right? And so in advance, as the economy gets more advanced, more connected every year, there's so many different points and so many different things that we can dissect every recession that we've had, and there's still going to be new ones that are caused for different reasons. So going back to what we've talked about so far on this live stream is building a solid portfolio, understanding your time horizon, and buying the best quality in each sector, just as Joseph said, I think is going to help you weather really any storm. And I like to say this from an overall viewpoint: the only way people truly lose is by not investing at all.
Absolutely, great advice. I think that's actually probably a great place to kind of start wrapping this up. My laptop battery is about dead, so I don't want to leave you all hanging here. Loved the video there, though. A lot of great comments and questions. And again, something that we've never done here on the channel. I don't think anybody else has ever done this on YouTube. Live streaming at 2 channels simultaneously. Here with Kenny Robertson on his channel and my channel, Let's Talk Money. So if you're joining us, feel free to keep asking questions, because these are going to go on the comments in the video. But head over to Kenny's channel, subscribe, be a part of the community there.
And so for those of you that are watching from my channel, of course, check out Joseph Hogue. I've actually linked a really fun video that he did, really valuable video, in the description on my video. Check out his channel and subscribe. He has if you like my videos, you will like his. He has a ton out there, and he has a lot of experience, of course, what you've learned about today. So thank you guys so much for watching. I have to give credit to Joseph on this one. His idea, his mastermind brainchild here. So thank you everyone for watching, and again, continue to send those comments, and we'll check them out at a future point in time.
Excellent. Kenny, do you do your regular live streams, or when can people find you as far as videos and live streams?
I upload every week, whether it's an actual scheduled video or live stream. So I upload every week. People can find me, and I do upload all sorts of dividend stocks and personal finance, and specifically niche real estate investing. So if you're interested in any of those, you might like my content.
Excellent. And Let's Talk Money. We're coming at you 3 days a week, Monday, Wednesday, and Friday. Excellent videos. I love talking about investing. Like I said, equity analyst background, working with venture capital and private wealth management. So I love talking about investing, but I think the real opportunity is in those passive income, those business ideas that we talk about. So definitely check those out. And then I like to do these live streams Sundays at 1 p.m. Eastern, 10 a.m. Pacific. So join us on those. Love this face-to-face relationship, this interaction we get on these live streams. So yeah, love it. Great discussion. And this is great.
Excellent. Well, thank you everyone for watching, and we'll catch you guys next time.
That's it.
That's it.